whatever I'm taking here, whatever notes I'm using to teach today, that notes I'll be sharing with you. Okay. Anyway, I'll be giving you my notes. Yes. This is a 2-day revision session. In the first 4 hours, I'm planning to complete the entire syllabus. First 4 hours means today. Today, from 4 p.m., which is already on, till 8 p.m., we will be covering every concept in FR. And tomorrow, we have one more session. And at the same time, from 4 p.m. to 8 p.m., we have a schedule. At that time, we will be covering question practice session. I'll teach you how to make use of my ACCA practice platform. Okay. Many of you are attending your first ACCA exam. I know many of my students already requested me to teach them how to do mock exams in ACCA platform. So tomorrow, I'll teach you how to use ACCA practice platform, and we can solve a few essay questions, 20-mark question. Okay, so that's our plan for this rapid revision, for this marathon revision. Are you on? Can we start? Okay, I hope the screen is visible.
Yes.
Yes, I'll surely teach section C. That is kept for tomorrow. Section C, you have essay questions for 20 marks, and we will do, if possible, 5 or else 4. Minimum 4 essay questions I'll be teaching you how to crack your essay questions, section C questions for 20 marks. But today we are into the concepts. We will revise each and every concept in financial reporting today. And tomorrow, after the overall revision, after making sure that you are done with your conceptual part, tomorrow we will be doing your section C questions. Ashit, is that okay? Yes. So let's start with today's section.
This meeting is being recorded.
So just as we discussed, our plan for today is conceptual revision. We will revise everything in financial reporting, but not in detail. It's an overall recap. We have so many IFRS and IAS standards in financial reporting. We will cover each and every standards. What are the main rules and what are the accounting treatments? Okay, then we will be covering consolidation, that is group accounts. What happens if 2 or more companies come together? What happens if there is an acquisition? We will complete each and every rules regarding consolidation. And we have interpretation, how to interpret these statements. These are the core topics of financial reporting. Everything we will be covering today. And tomorrow, we will be practicing essay questions for 20 marks, C-part questions. And I'll teach you how to make use of the my ACCA platform. Okay. So before starting, can anybody tell me what is the objective of financial reporting? You might have watched recordings or you might have had your own live classes to help investors make decision. That is one point. Very good. Any other points? Why do you need financial reporting? What is the actual objective of learning this subject? Anything else? To help management take decisions. Yes. Yes. You're all correct. You're all correct. You are into the final part. Pash, Soumya, both of you, you are discussing about the decision making part. Yes, yes. You can write so many points, but before that, your ultimate objective of financial reporting is to understand how to deliver this. Okay, decision making is an objective for users, very good. For users to help them make decisions, whether it's investors. For investors, they will be making use of these financial statements for their investment decisions. For businesses, for their managers, they will be making managerial decisions. Okay. Yes, to know company's financial position. Very good. So, in short, you can say that your objective is to prepare financial statements. To prepare financial statements. Okay. And this financial statement will help you to make the decisions. Okay. Your final point, you are very correct. For the users or the stakeholders, they need to make financial decisions. And what will help you to make these decisions? Financial reports or financial statements. So our objective of learning financial reporting, of learning this subject, is to prepare financial statements. How can you prepare financial statement? What are the rules and regulations? What are the accounting principles? All those things we will be learning in financial reporting. And throughout this subject, you will be thinking from the perspective of a senior accountant. Okay, why am I calling you senior? Why can't we be junior accountants? The junior accountants, what they will do is the initial recording. That is, if a transaction occurs, they will be initially recording it in the form of journal entries. That is the first step in accounting. Secondly, you will be posting these records from the journal entry to the ledger. Okay. Somebody is unmute. 1 second. Yes. So, some noise. Yeah. So my point here is, initially, the junior accountants will be doing the bookkeeping part. They will be recording the journal entries. They will be posting to ledger accounts. And from the ledger account, they will be preparing trial balance. Now, we are the seniors. Okay, seniors. The senior accountants will go to the final step in accounting, that is statement preparation. The final step in accounting, which is FS preparation. Okay, there are 4 steps in accounting. First step is recording in the form of journal entry. Second step is preparing ledger accounts, posting to ledger accounts. Third step is preparing trial balance using the final closing values from ledger accounts. From the ledger account, you'll be preparing trial balance. That is the third step. And the fourth and the final step is preparation of financial statements. Okay, so this final step, this last step is for us seniors. So we are learning basically about the last step in accounting. And after this preparation, we need to understand how to analyze these statements. How can we make decisions based on these statements? Okay, so we can say the ultimate objective of learning financial reporting is to prepare financial statements and analyze these statements to help the users in decision making. Okay, that is the objective. And we need to think from the point of view, from the perspective of senior accountants, where you are only making, where you are only required to do the final step in accounting. Okay, we are ACCA students. What is the full form of ACCA? There are still some people who don't know the full form. Anybody?
Association of Chartered Certified Accountants.
Very good. Association of Chartered Certified Accountants. So we have the term accountants. And you know what? This subject that we are learning, that is financial reporting, this is a core portion of accounting. Okay, in other subjects, that is financial management, performance management, auditing, all those are different streams. But as an ACCA student, we can say that financial reporting is the core, and you have so many connective subjects from financial reporting. So this is a connection, this is a link to many other subjects in ACCA. Okay, we have 13 papers in ACCA, and I can confidently say that financial reporting is a bridge for ACCA papers. So I need you to understand each and every concept in financial reporting. and make sure that you'll crack this June session ACCA FR exam. Okay, so let's move to our topics. Your first topic is conceptual and regulatory framework for financial reporting. We have a structure, a basic structure for financial reporting. Who are the dealers? Who are the members who makes the decision? What is the financial reporting standards? Okay, what are IFRS standards? What are the rules and regulations? Okay, all those things. There need to be someone who laid down these rules, isn't it? So the board or the committee who is laying down these rules and regulations, we call it the regulatory framework. And there are certain conceptual things that you need to understand, and that is conceptual framework. This conceptual framework is a guide which helps you understand the rules and regulations and principles of accounting. So, what is conceptual framework? Conceptual framework is a guide. It is a book. Let's assume like that. It is a guide that has all accounting concepts, rules, and principles, which helps you to decide what to do in a particular situation. Okay, you are trapped in a situation in a company, you had a transaction. In this transaction, what is the rule that you have to apply? So, this conceptual framework will help you to make decisions because it contains all rules and regulations and principles of accounting. And what about regulatory framework? Regulatory framework includes a framework or a board, like what, a group of people, a group of bodies who frames these accounting principles and accounting standards, all those things. So we will understand what is the elements of conceptual framework and who all are there in the regulatory framework, the decision makers, okay, the ultimate body for preparing the IFRS standards and for making the like what final decisions regarding the accounting treatments that we are learning. Okay, the globally recognized standards, who are behind that? That is the regulatory framework. The regulatory framework is simply a body who lays down these regulations, rules and regulations based on accounting. And conceptual framework is the book. It is a guide that helps you to refer all rules and regulations regarding accounting standards. So when it comes to financial reporting examination, I can say that this is the least tested part. In FR, you have so many things to learn, and this conceptual and regulatory framework part, this is least tested. A maximum of 4 marks you can expect out of 100 marks exam. A maximum of 4 marks can be expected from conceptual and regulatory framework. The remaining will be tested from standards. We need to learn each and every standard in detail. So from the standards, you will be tested for your exam, and from consolidation, you can expect high marks, and from interpretation also, you can expect high marks. But this portion, we need to cover this portion because we need to understand who is behind the accounting rules and regulations. Okay, who is behind the preparation of IFRS standards. So just for your understanding, I have this topic here, but for exam point of view, this is comparatively least relevant topic. And in your plan, if you need a reference, the reference will be chapter number 6 and 7. Let's go through these. Frame. We have 4
This meeting is being
Foundation
recorded.
is superior. And one of the main objectives of IFRS Foundation is ensuring proper funding. Okay, so these are the two main objectives of IFRS Foundation. Okay, IFRS Foundation is the superior body among all these four bodies. IFRS Foundation is superior, and its objective is to ensure that proper funding is happening between for IFRS fund they require that is necessarily available. To ensure this, you have the IFRS Foundation. Then the second one is International Accounting Standards Board, IASB. IASB is the main body who is responsible for preparing the standards that we are going to learn in FR. So the board is the independent standard setting body of the foundation. Its members are responsible for the development and publication of IFRS standards and interpretations developed by the Interpretations Committee. So the IASB will take help from the Interpretations Committee, and they will be making standards, whatever the Interpretations Committee have interpreted. We'll discuss the objective of Interpretations Committee also. So whatever the Interpretations Committee has as a concern, IASB will be solving this concern. Whatever issue is raised by the Interpretations Committee, IASB will have a solution for this issue in the form of international accounting standards, international financial reporting standards. Okay, so IASB is the one who provides solution for all accounting issues. For whatever accounting issues that a company is currently facing, IASB will be giving a solution in the form of international financial reporting standards. So the Interpretations Committee, what will be its role? The committee will be responsible for providing the understanding the issues that companies are facing. The IFRIC reviews widespread accounting issues on a timely basis and provides authoritative guidance on these issues. So their objective, the Interpretations Committee's objective is to interpret the accounting treatments, the existing accounting treatments, and the current issues that companies are facing based on accounting. So these issues, the Interpretations Committee will be identifying the issues that are faced by the accounting firms or companies, and they will report these issues to the foundation and the IASB. So IASB will consider all these issues and they will prepare IFRS standards. Okay, they will prepare IFRS standards as a solution to each and every issue raised by Interpretation Committee. And that's how the regulatory framework works. Now we have one more person in this group, that is IFRS Advisory Council. As the name suggests, its role is to provide advice to all other members. The council is a formal advisory body to the board and the foundation. It will be with respect to the advice given by the advisory council. So in the regulatory framework group, there are four members: IFRS Foundation, who is the superior body and ensure IASB, that is the independent standard setting body. IASB gives solution to each and every accounting issues. And who will identify these issues? The IFRS Interpretations Committee is responsible for identifying each and every issue faced by a firm or a company. Then we have one more person, that is IFRS Advisory Council. And this Advisory Council provides advices for IFRS Foundation and IASB decisions and for preparing standards. Okay, so understand the role, the ultimate objective of each four of these members, and all of them together forms the regulatory framework. Okay, so this simple understanding based on each and every member is enough. You don't need any in-depth understanding about IFRS Foundation, IASB, Interpretations Committee, or Advisory Council. Just understand their basic objective. Regulatory framework. What is the basic objective of all these members? Okay. This is the regulatory framework. And when you are preparing IFRS standard, who is responsible for preparing IFRS standard? IASB. IASB is responsible for preparing IFRS standards. So what is the procedure for preparing IFRS standards? Firstly, the board identifies a subject and appoint advisory committee to advise on the issue. We know who is advisory committee. So the advisory committee will take the first step. The interpretations committee will take the first step and they will ask the advisory committee to provide advice. So the board identifies a subject and appoints advisory committee to advise on the issue. Now, the second step is the board also publish a discussion paper for the public comment. So initially, before making the final decision, the board, the IASB, will be publishing a discussion paper for public comments. Then the third step is the board publishes exposure draft. Board publishes exposure draft for public comment, being a sample version. After discussion paper, the third step is to prepare exposure draft, and finally the board publishes the final text for IFRS standard. So it's not like they will make their own decision without discussing with anybody. Okay, it's the ultimate decision is made by IASB, but still IASB is taking the help from advisory committee and the public to make the final decision. Before framing a standard, IASB take the advice from advisory committee and from the public through discussion paper and exposure draft. Okay, so these are the 4 steps for preparing international financial reporting standards. Step 1, take advice from advisory committee based on an issue. Step 2, publish discussion paper. Step 3, prepare exposure draft. And step 4, the final draft is prepared and published. Got it? These are the steps in preparation of IFRS standards. Now, just as we discussed, what is the objective of preparing these IFRS standards and what is the objective of financial reporting? The objective of financial reporting is to provide financial information about the reporting entity that is useful for investors, lenders, and other creditors in making decisions about providing resources to the entity. So, in short, what is the objective of financial reporting? It is to prepare financial statements and to prepare financial statements in a way that is understandable to the stakeholders. The stakeholders includes investors, government, employees, everyone. So for all these stakeholders, we need to make financial statements that is understandable and in a manner that it helps each of them to make their own decisions, investing decisions, managerial decisions, or whatever decisions. Okay, so the ultimate objective of financial reporting is preparing financial statements to help the stakeholders to make decisions. Okay, to help stakeholders to make financial decisions. That is the objective. Now, for whatever financial statements we are preparing, we have certain qualitative characteristics. Okay, these are the qualitative characteristics of financial reporting, and this is an important topic. Okay, this is a very important topic. We have 2 classifications for qualitative characteristics. The first one is fundamental qualitative characteristic, and the second one is enhancing characteristics. You can say fundamental and enhancing. Fundamental qualitative characteristics and enhancing qualitative characteristics. So whatever is discussed in this class, it is basically only theoretical. For examination, you can expect a 60% problematic questions and remaining 40% for theory, for explanation. But here in today's class, we are going to the conceptual aspect, for the theoretical aspect. So when we are preparing statements, okay, your objective, your ultimate objective is preparing statements, isn't it? So when you are preparing statement, you need to make sure that certain quality are met. Quantitative aspects we will be discussing, that is a major portion in financial reporting. And there is also a minor portion, which is the theoretical part, the qualitative part, qualitative characteristics. The first qualitative characteristic, first classification of qualitative characteristic is fundamental qualitative characteristic. There are 2 fundamental characteristics. So the first one is relevance and second one is faithful representation. Fundamental qualitative characteristics are relevance and faithful representation. Let's discuss in detail what is relevance and what is faithful representation. The information given in the financial statement is relevant only if it has the ability to influence the economic decision of users. We need not include all. If you are preparing a statement, only the relevant information, only the information that can influence the economic decision of users need to be included. That is the first point. To say that users, then only we can say that this information is relevant and it must be included in the statement. So any irrelevant information, we can say any immaterial information. Sometimes for a big company, you'll have stationary purchases. It is not necessary that you need to include this stationary purchase expense in your statement because it is very immaterial compared to other transactions happening in the company. So only relevant information need to be included in the statement. This is one of the fundamental or basic. Fundamental, the term meaning is basic. This is one of the basic characteristic of financial reporting. We must ensure that it is provided on time to influence the decisions. So, available on time. This is also a factor that represents relevance. Okay, if the information is not available on time, then it's of no use for decision making. You are making the decision today, and this information is outdated. Okay, you are getting a piece of information that is related to previous year. In that case, this is of no use, isn't it? So to be relevant, we have two conditions. The first one is this piece of information must have the ability to influence the economic decision of users. That is, it must be material in nature. And there is one more factor affecting the concept of relevance, which is the information must be available on time. It must not be outdated. Okay, it must not be outdated. We can say the first condition for relevance is for economic decision making, it must be material. Only material items are included within the statements. And it must be updated. Okay, we can say not outdated. Outdated information will not be included in the statements. Okay, so that's about relevance. Now we have one more fundamental characteristic, that is faithful representation. Every piece of information given in the statement must be faithfully, faithfully, or honestly presented. Can you please mute? Okay. So the second fundamental characteristic is faithful representation. Legal form. Important accounting concept, that is substance over legal form. All these accounting concepts, materiality concept, then substance over legal form concept, accruals concept, prudence concept, all these concepts you might have learned in your basic accounting in when you were learning F3 financial accounting or in your degree program or in your +1 +2 whatever
This meeting is being recorded. This meeting is being recorded.
You have calculated this figure. Let's say, for example, depreciation. If you have calculated depreciation using straight line method, then for verifying this, you have to follow straight line method itself and recalculate it. Okay, you cannot count cash and ascertain the amount of depreciation, isn't it? So we have indirect method and direct method. Direct method is where you sit and count cash. Okay, directly you are verifying the amount given in the statement. And indirect method is where you follow a particular format or you follow a particular method and you recalculate the value using the same method and make sure that the information given in the statement is correct or accurate. Accuracy is a very important condition to be maintained for a financial statement because it is used by users for their decision making. Then we have another enhancing characteristic, that is timeliness. We already discussed that in case of relevance, which is our basic characteristic, to be relevant, for a piece of information to be relevant, it must be available on time. And here also we are like what stressing that sentence itself, timeliness. Timeliness means having information available to decision makers in time to be capable of influencing their decision. Okay, so timeliness, you can include this factor both as a basic condition, basic characteristic, and an enhancing characteristic. Okay, so timeliness means every piece of information included within the statement must be updated. It must be up to date. No outdated information will be given in the statement. And the final characteristic is understandability. Financial information should be understandable to the users, and it depends upon the way in which the information is presented and the capabilities of the users. So when you are preparing financial statement, you are assuming that all users of this financial statement is having reasonable knowledge, reasonable understanding about accounting principles and rules. Okay, maybe usually all employees or all public will not have the knowledge of accounting and economic principles. But when you are telling that this is helping the users to make decisions, we are assuming that all these users, all these stakeholders have sufficient knowledge based on accounting and economic rules, economic accounting principles. Okay, so that is understandability. With this four criteria, making sure that all these criteria, all these characteristics are incorporated within the statement, we will be preparing statements. Okay, we have two basic characteristics, that is relevance and faithful representation, and we have four enhancing characteristics, that is comparability, verifiability, timeliness, and understandability. So these are all characteristics incorporated within a statement. Okay, these are usually tested for 2 marks to make sure that you understand the concepts. Now we have elements of financial statements. We have already discussed the characteristics of financial statements. Now let's see what all are included in a statement. We have 5 elements of financial statements, that is asset, liability, equity, income, and expense. Okay, so these assets means what? I think you'll already be familiar with all these termings, but we have definitions laid down by IASB. That's why you have to go through this. These are definitions by IASB. You have to understand the definition laid down by IASB because in a 2-mark MCQ question, they can give you 4 options and you need to choose which among the following is correct. Maybe every sentence feels similar. You feel like this each and every sentence is a definition for asset. You know what is asset. You know the meaning of asset, but that is not enough. You need to understand what is the definition laid down by the IASB. So as per IASB, asset is the present economic resource controlled by the entity as a result of past event. That's it. Just a simple definition. You can split it into 3. We have a present economic resource. That is, the asset is a resource for the company. Then it is controlled by the company, and this asset is controlled as a result of a past event. Okay, maybe through purchase or maybe through like what acquisition. So this is an asset is an economic resource controlled by an entity as a result of past event. And you need to understand the definition of liability. Present obligation of the entity to transfer an economic resource as a result of past event. You have equity. Equity is the residual interest in assets of the entity after deducting all liabilities. So what does this sentence mean? Anybody, can you tell me the basic accounting equation? Basic accounting equation. Prashant, can you please stop doing this on the screen? Yes, yes, very good, very good. So all of you know what is the basic accounting equation. Total asset equal to total equity plus liability. So I can say that from this definition, residual interest in the asset of an entity. Why is that given like that? Equity. From this basic equation, you can see asset equal to equity plus liability. Now, can you rearrange this equation? Equity equal to what will be equity? Just rearrange the equation. Very good. Equity is equal to asset minus liability. Total asset minus liability. So that is the definition of equity. The residual interest in asset, whatever is remaining in the asset after deducting the liability, that is known as equity. So what they have did, what IASB have did is they simply rearranged the basic accounting equation and framed a sentence. Residual interest in asset of an entity after deducting all liabilities, which means equity is equal to asset minus liability. That is the definition given by IASB for equity. Then we have two more elements, income and expense. Increase in assets, decrease in liability, and increase in equity other than contributions from shareholders. That is the definition given to income. We all know what is income. Okay, anything that is generated as a revenue from the company for a company, that is known as income, isn't it? Anything that leads to an inflow, that is income. But we cannot give our own definition because IASB has already provided a definition for income and expense. So these are the definitions for income and expense that IASB has given. And what is expense? It is decrease in asset, increase in liability, or decrease in equity other than distribution to shareholders. So you need to go through these definitions and make sure that when you get an MCQ question, you will be grabbing those 3 marks in seconds. Okay, you will not be sitting and thinking in the exam hall, oh, what was the definition of asset? Okay, it's just simple definition. Just go through this definition, but you have to go through this definition. You will not be ignoring it because in my exam, when I was writing 5 years ago, when I was writing my exam, I had this thing. Okay, the definition of liability, as per IASB. Okay, and I was confused. I know what is liability, but I actually don't know the definition laid down by IASB. Okay, so make sure that you go through these definitions, even if you know what is asset, liability, equity, income, and expense. Okay, now measurement basis. As per the conceptual framework, we have 4 measurement bases. How to measure assets and liabilities. We can use any of the 4 values in a particular situation given. The first one is historical cost. If somebody is asking you, what is the value of this asset? Then ask him, what value do you want? Do you want the historical cost, or do you want to know the current cost, or fair value, or do you want to know the value in use? So all these figures represent the value of an asset, but all these values will be different. We need to understand what is historical cost, what is current cost, what is the fair value, and what is value in use. See, historical cost is the actual amount of cash paid or consideration given to the item. Historic cost means the purchase cost. Okay, when you are buying an asset, here I'm taking asset as an example, but measurement basis is also for liabilities. Keep in your mind, this for theory part. So if you have an asset, for example, you have a machinery, and you bought this machinery for 1 million. So whatever is the money that you have spent for acquiring this asset, that is the historical cost. Machinery, 1 million, purchase cost. The purchase cost, whatever consideration you have provided when you bought this asset, That is known as historical cost. Now, for the same machinery, what is the current cost? Okay, let's say you bought this machinery for a brand. The brand name is Y. Just an example, you have a brand called Y, and with this brand, you bought an asset. And when you bought this asset, you gave 1 million as consideration. Now, what is the current cost? The cash that would be paid to replace the asset at current value. You might have bought this asset 2 years ago. Now, today, if you are going to the market and you are buying this brand Y's machinery, in that case, the value might have increased or the cost might have decreased, isn't it? Usually, we have in the market, we have inflation and we have demand and supply. Based on all these things, the price is fixed. So, for the same type of machinery, when you go to the market today, what is the value? What is the cost for this asset? So now, today, purchase might have happened few years ago or few months ago. So whatever happened, whatever is the money that you gave, that is the purchase price. Current cost is today's cost of same machinery in the market. It may be now the market has like what very it has a very big demand, very huge demand in the market. So its value is now 1.5 million. Okay, you bought this asset for 1 million. Now, if you want the same asset, you're planning to buy the same asset for the second time. In that case, your current cost will be 1.2 million. Okay, whatever is the current market value. Now you have fair value. Always what happens is students get confused with current cost and fair value. Fair value is what you can get for your asset, your current asset. You have this machinery that you bought for 1 million. And today, if you are planning to sell this asset, what is the value that market is ready to give you? Fair value is the current market price at the disposal. So understand the difference between current cost and fair value. Current cost is the cost of the asset. If you are going to the market to purchase the same asset, then what is the cost of this asset? What is the price that you will be giving to the market? Okay, to the supplier. But when it comes to fair value is the value of this machinery, value of asset in active market, and this includes the value of asset in its present condition and location. Okay, so maybe you bought this asset 2 years ago. You have used this asset a lot, and now it has its value has declined. Okay, this machinery has been in your office, in your building for like 2 years, and these 2 years you were using this machinery continuously. And now today, if you are selling this asset, if you are selling this machinery, nobody will be giving you 1 million, isn't it? So whatever is the reduced value, whatever is the value of this asset in the active market, whatever the market is ready to give me for this machinery in its present condition at this present location, that is the fair value. Now you have one more thing, that is value in use. It is the discounted value of future cash flows. You know that asset, it represents the like what, economic resource of a company. So from this asset, from this resource, whatever is the inflow that you can expect in the future, maybe this asset has a useful life of 10 years. And in this 10-year time, uh, based on the like what latest information available, you will be making some predictions. Every year you can get 50,000 from this asset. Okay. Every year there will be an inflow of 50,000 from this asset. In that case, you will be calculating the present value of all these future outflows. So this value in use is the present value of all future inflows from the asset. You bought an asset with an objective to earn money, isn't it? You are expecting inflow from this asset. So whatever inflow that you are expecting from this asset, you will be taking the present value of all these assets. Okay, I hope you know what is present value. Do you know what is present value? In financial reporting, you will come across this term eventually. Okay, what is PV? Present value. Can you give me an equation for calculating present value? Sometimes, for example, in your question, they will be giving you a value. This payment is to be made after 2 years, or this receipt, you will be getting this inflow after 2 years or 3 years. In that case, you need to consider the concept of time value of money. Time value of money means the value of money diminishes over time. When you're moving forward, the value of your money will be declining. Based on this concept, whatever is the future value given in the question, you have to calculate today's value, that is present value. Very good, Ashyat. Uh, Future value into discount factor. Exactly. Present value equal to future value into discount factor. You need to know what is discount factor. Discount factor is equal to, you have an equation that is 1 divided by 1 plus r raised to n. Exactly. Great. Perfect. Good. 1 by 1 plus r raised to n. So this present value concept, there are so many instances in financial reporting where you have to calculate present value of inflows and outflows. Okay, whenever there is a value given in your question, that is like you have to make payment on a future date, or you will receive some money on a future date. At that time itself, this present value concept needs to be there in your mind. Okay, present value only will be recorded in the statement. You are preparing the statement today. So in today's statement, you cannot include a future value. So whatever is the future inflow or outflow, you will be calculating present value of that amount. That is by applying this equation, future value into discount factor. For the calculating present value, relevant information will be given in your question. R means the rate of interest, prevailing, the rate of prevailing interest. Then you have N. N means the number of years. If you are calculating the present value of a future value after 2 years, for example, you have a receipt after 2 years means your N will be 2. If you have a receipt of 5 million after 10 years means then N, the number of years will be 10. So N means number of years, R is the prevailing rate of interest. When you apply this to the equation, you will get the discount factor, and always discount factor will be a 0.xyz figure. Okay, so you will be multiplying the future value with this discount factor, then you can get your present value. Okay, so here my point of present value is when somebody is asking you what is the value of your assets. Okay, what is the value of your asset means you can say my asset has a value of this much, where it is a value in use, where you are expecting 5 million as an inflow on future date. So calculate the present value of this 5 million, and whatever is the present value, that can be called as the value of your asset. So you have 5 values with respect to assets. The first one is historical cost, that is on if somebody is asking you what is the value of your asset, if you want, you can tell that the value of my asset is 1 million. I bought it for 1 million. And if you want, you can tell current cost. The value of my asset is 1.5 million. In the market today, if you go and ask the value of this asset, it will be 1.5 million. Then, if you want, you can tell the fair value. Fair value means when you are ready to sell this asset in its present condition in this current location, what is the value that market is ready to give you? Okay, in this present condition. Okay, that is a fair value. So you can tell that my asset has such and such value. The market is ready to give me this value. Then, or if you want, you can tell my asset has the value in use of this much. Okay. Will direct cost attributable be included in this? Yes, yes, of course. Every direct cost attributable to the purchase will be included here. Okay. Every direct cost means Harsh, please don't draw on the screen. Everybody can see. Okay. So this historical cost, it includes every direct cost related to purchase. We'll see what are the direct costs related to purchase. Includes every direct cost of purchase Not only purchase, whatever is the direct cost that you incurred in order to bring this asset to its present location and condition, every cost, whether it is subsequent or initial, it can be included in the historical cost. Sorry, not subsequent. I mean this subsequent in the sense until the date of installation. Okay, until the date it is ready for use. So whatever is the direct expense that you have incurred based on this purchase, you can include it in the historic cost. Any doubts? Any other doubts regarding what is historic cost, current cost, fair value, and value in use? So these are the measurement basis for all assets and liabilities. You can expect question for like what? Only theory questions, 2 more questions from this part. Usually calculation questions are not, will not be coming from this part. Okay. That's all about the basics, the conceptual and regulatory framework. Who all are the members of the regulatory framework? How do you frame IFRS standard? Then, what is the objective of financial reporting? When you are preparing statements, what are the qualitative characteristics? What are fundamental characteristics? What are the enhancing characteristics? What are the elements of financial statements? And what are the measurement basis? These are the important things that you need to understand from chapter number 6 and 7 based on conceptual and regulatory framework. Okay, got it? Yes, good. Now we will see standards one by one. So before going into the standards, you have to have the picture of all statements. What are the financial statements? Now we already discussed that our objective is preparing financial statements. So isn't it important that you know the format of these statements? So as per IAS 1, which is laid down by our IASB, International Accounting Standards Board, we have IAS 1, that is presentation of financial statements. There are 5 financial statements, and each of them has a predetermined format that you need to keep. Okay, even if there is a slight change, it is not not a big issue. But you have a basic structure, a basic format laid down by IASB as per IAS 1. The first statement is statement of financial position. We can call it SOFP. SOFP. That is the most important statement which helps you to analyze the financial position of a company. Then you have statement of profit or loss and other comprehensive income, or statement of profit or loss plus a statement showing other comprehensive income. Why is it given like this in separate manner? It is just to show that you have a choice. Okay, if you want, you can prepare SOPL plus OCI in one statement itself. You can do both. Okay, give the main heading, statement of profit or loss, and afterwards, when you calculate the profit or loss, then in the same statement itself, give a subheading, other comprehensive income. Okay, otherwise, you have an option to do separately, to prepare these statements separately. That is, in one paper, you are calculating the profit or loss, and in another paper, you are calculating the other comprehensive income. But in our examination, in financial reporting, you only need to go through this first one, SOPL and OCI. Okay, we are not preparing the statement separately. We are preparing statement of profit or loss and other comprehensive income in a combined statement. Okay, so the second statement is SOPL and OCI. Then you have statement of changes in equity, that is SOCIE. And you have statement of cash flows, that is SOCF. And finally, you have disclosure notes or explanatory notes, which does not have a proper format. Disclosure notes. Okay. So that's it. These are the 5 statements that as a senior accountant that we are obliged to prepare. Okay. Our objective is to prepare the statements, and there are 5 statements that you need to prepare. We need to understand the preparation of all these statements. But for your examination, they will be testing only preparation of SOFP, SOPL and OCI, and very rarely SOCF. They will not be asking you to prepare statement of changes in equity or the disclosure notes. Okay, so these are the 3 important statements that you need to understand. And yes, that's it. So as per IAS 1, we have a particular format for each of these statements. Let's go through these formats. Pro forma for statement of financial position. This is the pro forma for SOFP. You have three main headings here. No, we have two main headings. The first one is asset. First main heading is asset, and the second main heading is equity and liability. Okay, so these are the two main headings of statement of financial position. SOCIE is not that important, and in your examination, they will not be asking you to prepare the statement. But you need to understand what are the workings happening inside SOCIE, what are the elements of statement of changes in equity, and what all additions will happen, what all deductions can happen. Just understand, but it is like what? Its preparation will not be tested. Got it, Harsh? Yes. So here, the first statement that we are looking into is statement of financial position. In statement of financial position, you will be considering three important elements of SOF, your statement. Your financial statement has five elements, that is asset, liability, equity, income, and expense. So the first three elements, asset, liability, and equity, these three items will be included in your statement of financial position. And the remaining two, that is income and expense, those elements are included within your statement of profit or loss, your next statement. So these five elements, these are incorporated within two different statements. The first one is SOFP, and you are preparing SOFP as at a particular date. You note this as at 31st December. It may not always be 31st December. Whatever is the year end, on that date, you will be looking what all assets are there in your company, what all liabilities are there in your company. Okay, what is the equity position of your company? So, as on a particular date, what is the total of your asset, what is the total equity, and what is the total liability? You need to match the account, you need to prove the accounting equation here. Okay, you already know what is the accounting equation, that is asset equal to equity plus liability. So, you are proving the accounting equation based on this statement, okay, through this statement. And you can classify your asset as non-current asset and current asset. In the non-current asset, you have property, plant and equipment, investment, and intangibles. Now, let me tell you, you have standards for each and every values here. Okay, in order to calculate the value of property, plant and equipment, you have certain standards. That is IAS 16, IAS 40, IAS 20. All these things will help you to ascertain the value of property, plant and equipment. Then, to calculate the value of investments, you have IFRS 9. Now, value of intangible assets. To calculate value of intangible assets, you have IAS 38. Okay, so these are the three non-current assets coming in your statement. Now we have current assets. Current assets are inventories, trade receivables, cash and cash equivalent, and asset held for sale. We have standards for each of them. For inventory, you have IAS 2. Then for trade receivables, you will be you'll be considering the value of receivables as per IFRS 15, revenue from contract with customers. Then you can have the value of cash and cash equivalents through cash flow statement, that is IAS 7, statement of cash flows. It is a separate statement, that is IAS 7. Then you have asset held for sale. The reference is IFRS 5. Okay, so in each and every standards, you are calculating a particular value that is necessary for your statement. Okay, what is the amount to be shown in SOPL? What is the amount to be shown in SOFP? So to get an answer, you have standards. Okay, so when you add up all these non-current and current assets, you can get total assets. Now we have the next subheading, that is equity and liability. In under this equity and liability, you can give another heading, capital and reserves, or you can give just equity. Okay, give a subheading, equity. Under equity, you have four main elements: share capital, share premium, revaluation surplus, and retained earnings. Otherwise, if you want, you can do like this: share capital and retained earnings. These are the two main items in SOFP. And you can add OCE, other components of equity. In this other components of equity, there will be revaluation surplus, share premium, and the remaining equity elements. Okay. If you want, you can split and record. That is share capital, share premium, revaluation surplus, retained earnings. You can split all these elements and you can record it under the equity. Otherwise, you can consider them as other components of equity. Right? What is this? No, Karthik?
Sorry.
You were chatting with somebody else? It's okay. I thought the concept that I explained was wrong. Okay, it's okay. So if you want, you can give a separate heading equity. And under the equity, there are four main elements: share capital, share premium, revaluation surplus, and retained earnings. And you gave a total. Okay, total equity. Calculate the total equity and keep it there for now. Then the next subheading coming under equity and liability is liability. You have classification for liability, that is non-current liability and current liability. Under non-current liability, the two main items coming are long-term borrowings and deferred tax. For long-term borrowings, you have IFRS 9, and for deferred tax, you have IAS 12. Then, for current liabilities, there are trade payables, short-term borrowings, current tax, and short-term provisions. For provisions, you have IAS 37. Current tax, there is IAS 12. Then, for trade payables, we also have this provision thing. IAS 37 can itself can be considered referred for calculating the amount of payables. Okay, so there are references for each values. In order to ascertain each and every value in the statement, you can take the help from IFRS or IAS standards. Okay, so that is why we are learning all these standards in financial reporting. Since our aim is preparation of statements, we need to learn these standards because these standards gives you the rules and regulation and the solution of what value to be taken to what statements. Okay, so this is the important, very, very important format that you need to keep in your mind. Pro forma for SOFP. Now, this is the pro forma for SOPL and OCI, Statement of Profit or Loss and Other Comprehensive Income. When you look at the heading, Statement of Profit or Loss and Other Comprehensive Income for the year ended. When you were preparing SOFP, your heading was at 31st December or as on 31st December. You are considering the values on a particular date. But when you're preparing SOPL and OCI, you're considering the values of a whole year. Throughout the year, what are the incomes that you generated? What are the expenses that you incurred? All those things will be included in SOPL and OCI. So in this format, you basically have two elements, that is income and expense. Okay, there are 5 elements, and among these 5 elements, 3 of them, asset, liability, and equity, is included within SOFP, and the remaining 2, income and expense, will be included in SOPL. And whatever income you generated for a particular year, and whatever expense that you have incurred for this year, that will be included in SOPL. And once you got the profit or loss figure, after that, you will be giving a new subheading, other comprehensive income. Under other comprehensive income, only 2 things will be coming: the gain or loss on revaluation or the gain or loss as per fair value through OCI model, FVTPL model under IFRS 9. Okay, so this is the basic format for SOPL and OCI. You get gross profit when you deduct the revenue from cost of sales. Then you have 2 expenses, that is administrative expense and distribution expense. Together, you can call them operating expense. This administrative expense and distribution expense, you will be calling them operating expense. Some companies will be preparing statements and they will be recording them separately. That is this administrative expense and distribution expense, they will be recording separately. And some companies, they will be including both distribution and administrative expense, they'll be combining it together and they call it operating expense. So when you deduct operating expense from gross profit, you will be getting profit from operations or operating profit, or you can call it PBIT, profit before interest and tax, or net profit. Okay. Now, from PBIT, if you deduct finance cost, that is interest expense, and you can add investment income, making these two adjustments, you can get your profit before tax, PBT. From this, if you deduct the income tax expense, you will be getting profit during the year, profit for the year, or profit after tax. Okay, so this is the basic pro forma for SOPL and OCI, which incorporates all income and expenses generated during the year. So these are the two important statements, SOPL and SOFP. Now this is the pro forma for statement of changes in equity, but just as I told you, we don't need the format. We don't need to learn the format for statement of changes in equity. Understand what are the adjustments happening here. We have four elements for equity, that is share capital, share premium, revaluation surplus, and retained earnings. So whatever adjustment is happening in all these four elements during a year, that will be coming under the statement of changes in equity. Okay, first take the initial balances. That is the previous year's balance brought forward, the opening balance. And during the year, this prior year adjustment is where you have an error. Okay, this happens only when there is an error. We will discuss based on the errors in IAS 8, prior period error. Okay, so whenever there is an error, you will have to make adjustments to the retained earnings. Then you will get the restated balance. From this opening balance itself, if there is no error, the opening balance itself will be the restated balance. You don't need to do it separately. So if you have a share issue during the year, it will be affecting the share capital and share premium. You'll be adding the issue to this share capital and share premium. Then, when there is a total comprehensive income, this total comprehensive income includes two items, profit or loss for the period, and you have other comprehensive income, the value from SOPL. So only after preparing SOPL, you can prepare statement of changes in equity and statement of financial position. Okay, so if there is a profit, you will be adding the profit figure to the retained earnings, and whatever there is in the other comprehensive income, you will be including it under a revaluation surplus. That is why you have two values here. So in other comprehensive income, if you have a value, that will be recorded under revaluation surplus, and whatever is the profit for the year from SOPL, you will be recording it, you will be adding it to the opening balance of retained earnings. Then, if there is dividend paid, I skip this. If there is a dividend paid during the year, that will be removed from retained earnings. From the opening retained earnings, the two adjustments are dividend paid, you will be deducting, and profits, you will be adding. That is the adjustment happening in retained earnings. And transfer to retained earnings, this is very rare and it is not mandatory. It is not mandatory. This is where you have to transfer excess depreciation from revaluation surplus to retained earnings. So since these two are equity elements, it doesn't make a difference for your statement. If your excess depreciation is 10,000, you deduct 10,000 from revaluation surplus and you will be adding the same exact 10,000 to this retained earnings. So it does not make an effect. Your net effect will be nil, zero. So it's not mandatory, but these are the maximum adjustments that can happen in an equity element of a company. Under equity, you have share capital. If there is a share issue, you will have to add the amount of share issue to the opening balance. That's the only adjustment in share capital. In the share premium also, only adjustment is where you have a share issue at premium. Then under revaluation surplus, you have two adjustments coming. That is, whatever value is included in the other comprehensive income, that will be added with the opening balance. And whatever is transferred to retained earnings, you will be removing this transfer value from revaluation surplus. Now, the most important adjustment that you have to understand from SOCIE is based on retained earnings. From retained earnings, you will be deducting the dividends during the year and you will be adding the current year's profit. So retained earnings, it is simply, you can assume this as a basket which has the profit accrued for every year. Okay, in the first year, you have some profit of 1 million. You put that profit in this basket, retained earnings. In the second year, you have a profit of 2 million. Again, you are putting this 2 million in the basket. So whatever is the profit or loss, if there is a loss, you will be deducting this value from the retained earnings. Okay, so retained earnings is a basket which has the profit and loss for the company. From this profit only, you will be giving dividends to the shareholders. That is why you are deducting this dividend value from retained earnings. So retained earnings has the profit for every year, and from this retained earnings, you will be removing whenever there is a loss. You will be having a deduction whenever there is a loss and whenever you are paying dividends. Okay. So these are the adjustments coming in statement of changes in equity. You just need to understand what all adjustments are happening, what all additions are happening, and what all deductions are happening in these equity elements. Okay, so these are the basic formats that you need to know. About cash flow statement, we will be discussing it separately as IA 7. Okay, so I hope you got an idea, you got the picture of SOFP and SOPL in your minds. These are the statements that you can expect for your essay question, 20 mark essay question. Okay. Now can we go to the statements one by one? Anything else you need to ask me? Yes. Great. So the first standard that we are considering is IAS 16, property, plant and equipment. So when your company is having a purchase of a non-current asset, or when you are planning to dispose of a non-current asset, or when you are revaluing the asset, all these situations comes under IAS 16. So IAS 16 is laid down by IASB as a solution for what value to include based on an asset in your statements. Okay, based on the non-current assets. And make sure this non-current asset that you are considering under IAS 16, it is only based on business assets. Business assets. Assets that you use for business purpose is treated under IAS 16. So what happens if you have any other assets that is not used for business purpose? For example, if it's used for rental purpose. Anybody know? We have another standard for this. We have a non-current asset. Non-current asset, for example, plant and machinery, building, furniture and fixtures. Yes, investment property, IAS 40. Very good. So, if you are planning to, if you are making use of this asset as an investment property, for example, you have a building and you are not using this building for office purpose. It's not for business purpose. You are giving this building as a rental. Okay, this is used for rental purpose or investment purpose. For that case, you have a separate standard. So don't always think that every land and building will come under IAS 16. So whatever assets that you use for business purpose, that comes under IAS 16. The recognition criteria is it is possible that the future economic benefits associated with an asset will flow to the entity. This is, we already told that it's regarding assets. To be an asset, you need to understand that there must be probable, it must be probable that you will have future economic inflow, future economic benefit. Then another condition is the cost of the asset can be measured reliably. So if you cannot, like you have a gift, you got a gift from somebody else, and it is a very unique thing. You don't have a value. Either you cannot get its historic cost. You did not give any money as it's a gift. You did not give any money, so there is no historic cost. And it's not a branded item. It is not available in the market, so you don't have a current cost also. Now, when you're looking for the fair value, nobody is going to give you any money for this. Okay, it does not have a market value also, and you don't have a future inflow also. For example, a statue. Okay, it's an asset, a very big painting or a statue. If in that case, these assets are not accounted under IAS 16 because it does not have a cost which can be reliably measured. It does not have a cost that can be measured reliably. So if these two conditions are met, it must meet the definition of an asset and it must also have a reliable measurement. Okay, a cost can be measured in either way. Okay, using any of this measurement basis, you need to ascertain the value of this asset. If measurement is not possible, then it will be excluded from the scope of IAS 16. Okay, so these are the recognition criteria, and every business asset will be included under IAS 16. As per IAS 16, initially, when you are purchasing the asset, so for every, can you please mute Siddharth? Yes. Okay. For every standard, you have this initial measurement and subsequent measurement. It simply means what is the initial value at the date of acquisition, okay, or at the date of commencement. The initial value of a non-current asset simply means the value to be recorded in the journal entry. Value. Your first recording happens in the form of journal, isn't it? Accounting procedure. First, journal entry. Second, ledger. Third, trial balance. And fourth, financial statements. So, value to be shown in journal on the initial date, at the date of acquisition. Suppose you are purchasing an asset in August and maybe you're preparing statements as your year end is 31st December. So as on August, when you bought this asset, what is its value? That is the initial value. Okay, this is the initial value to be recorded in the journal. This initial measurement is at cost. And what is the meaning of cost here? Cost. Cost includes all these things. See here, you have purchase price, import duties, cost of site preparation, then initial delivery and handling cost, installation cost, testing, professional fees, site overhead, and present value of dismantling cost. So these are the items included within the cost. Okay, in the initial cost, when you are writing a journal entry for acquisition of an asset, then at that time, the amount to be recorded in the journal entry is the total of all these figures. You need to learn this. In short, you can say that purchase price plus all direct expenditure incurred to bring the asset to its present location and condition. Okay, when it's available for use. Until it's available for use, whatever is the direct expenditures incurred for a company in order to bring the asset to its present location and condition, that is included within the cost. Okay, got it? You need to learn this. That is the initial value. Initial value is not recorded in the statement. In the statement, when you're preparing statement as on year end, you will be giving a separate value. That is called subsequent value. Initially, maybe for 2 months, they'll be asking what is the initial value to be recorded in the journal entry. At that time, you need to understand that amongst all these costs, you can add up all these costs incurred for a company when you're acquiring an asset. That is the cost to be included as the initial value. Then what should be excluded from cost? All administrative and general overhead. See, specific overheads, site overheads can be part of the cost, but general overheads will not be included within cost. Then startup and pre-production costs, abnormal waste, warranty, business rate, training costs. Just go through these. Whatever is included here, these will not be coming under cost. Okay. Now, initially, you will be recording in the journal entry at the cost. The asset will be recorded at its cost. But subsequently, when you are preparing the statement, what is the subsequent expenditure? Subsequently, you can classify the value of asset into two. You have capital expenditure and revenue expenditure. Capital expenditure, it is something that you can capitalize. Capitalize means it can be shown in SOFP. Okay, so you will come across this term eventually in this chapter, regularly in this financial reporting subject. To be capitalized means the value can be recorded in the SOFP as an asset. Then it cannot be capitalized or it need to be expensed means this is just a revenue expenditure to be shown in SOPL. So any value that can be included within the value of an asset is called capitalization. Then any figure which is just a normal expense to be shown in statement of profit or loss is known as revenue expenditure. For example, in capital expenditure, you have a criteria. You can note down this criteria. The amount, a subsequent amount to be capitalized means this particular expenditure must help to enhance the performance of an asset. Okay, it leads to performance enhancement of an asset, of existing asset. That is capital expenditure. So, for example, you have a machinery and every month from this machinery, you got 5,000 units as output. Now, you added a new component to this machinery. From now onwards, after adding this component, new component, you are getting 7,000 units as output every month. So, which means the performance of this asset, this machinery have enhanced. So whatever cost you have incurred for this performance enhancement, that can be included as part of the cost of assets. Okay. So capital expenditure means any expenditure that can be capitalized and can be shown in the SOFP. And there is one criteria for the cost to be capitalized. That is the performance enhancement of an existing asset. Any cost that is incurred to enhance the performance of an asset is known as capital expenditure. And you have two examples. First one is adding new components. And second one is overhaul expenditure. We'll discuss what is overhaul. Okay, overhaul expense. So these are the two examples for capital expenditure where the performance enhancement of an existing asset happens. Then you have revenue expenditure. These are normal expenditures like repairs and maintenance. Repairs and maintenance. These expenses, these are just included within your SOPL, your administrative expense. Okay. That's about capital and revenue expenditure. And subsequent, the term meaning is in the statements. Subsequently means value in statements. Value to be included in FS, financial statements. So subsequently, any capital expenditure will be included in SOFP and any revenue expenditure based on an asset will be included in SOPL. And what is the initial measurement? Initial value means the value to be shown in the journal entry. Subsequent value means the value to be shown in the financial statements. Subsequently, an asset can have capital expenditure and revenue expenditure. If it's a capital expenditure that helps to enhance the performance, then it can be capitalized in SOFP. If it does not lead to a performance enhancement, it is just for day-to-day maintenance. In that case, this expense is known as revenue expenditure and it will be included in the SOPL. Okay, got it? What is the subsequent values? Your next concept is depreciation. Subsequently, to calculate the amount of an asset to be shown in SOFP, you need an item called depreciation. What is depreciation? You might already be familiar about depreciation. Depreciation is the systematic allocation of depreciable amount of an asset over its useful life. Okay, so what is a depreciable amount? Depreciable amount means cost minus residual value. Whatever is the cost of the asset that you had initially recorded in the journal entry, that initial cost minus residual value or scrap value. When you are selling this asset after its useful life, what is the value that you can get? What is your expectation? That is the residual value. Okay, so initial cost minus residual value, that is the depreciable amount. And when you divide this depreciable amount using the expected useful life of an asset, you will be getting this depreciation, amount of depreciation. You know what is depreciation? Is it an asset, liability, equity, income, expense? What is this depreciation? In which element depreciation comes? Expense. Great. Very good. Even here, you can see that depreciation is a systematic allocation of the amount, of depreciable amount, isn't it? So this is the allocation of income, to be frank. Okay. Depreciation is an expense. Depreciation is an expense which is matched with the corresponding income generated per year from an asset. Okay, so you have a concept called matching concept. Based on the matching concept, you will be matching every income for a year. So 1 year, if you have an income, there will be a corresponding expense. That is the matching concept. So from an asset, you will be generating income, isn't it? For example, if there is a machinery, from a machinery, every year you will get income. So for matching this income, you have a particular expense known as depreciation. So depreciation is not an actual expense. You are not paying any money. Usually what is expense? Anything that a company incurs in the form of payments, outflow. But depreciation is not an actual outflow. And why is this concept important? This is based on matching concept. Okay, you are matching the income generated from an asset per year to a corresponding expense. That is depreciation. Depreciation must be charged from the date the asset is available for use. This is a point that you need to keep in mind. It's not the date of purchase. Usually we consider that as soon as we purchase an asset, we can make use of this asset. But in some rare cases, it will be like after purchase, it takes time. It takes 3 or 4 months for you to make it available for use. So in that case, this available for use date will be considered for depreciating. Okay, from this date, the asset is available for use. From that date onwards, you will be calculating depreciation. Usually, we consider the purchase date as the date on which asset is available for use. Got it? This is a very important concept. In the coming all standards, you will have to have the knowledge of this depreciation concept. Okay. The depreciation is an expense, and every expense will be recorded in SOPL. Yes, depreciation comes only under cost model. We'll come to it. We have two models, that is cost and revaluation model. But the thing is, depreciation comes under, we cannot say that depreciation comes under cost model. Depreciation is there in revaluation model also. But the point is, the depreciation value changes every year. You need to calculate the depreciation every year when there is a revaluation. Otherwise, if you're following cost model, at once only you need to calculate the depreciation. Okay, every year the depreciation will be same only as per cost model. Okay, you have one more model, that is revaluation model. If you are choosing that model, at that time also you have depreciation, but every year the value of depreciation will be new. Okay, new value of depreciation must be calculated. We'll come to it. Here, just understand that the normal way of calculating depreciation is cost minus residual value. But if you are following another model, that is revaluation model, we will have a small change to this equation. Okay. Got it? Yes. Now, we have three methods for calculating depreciation. That is straight line method, reducing balance method, and machine hour method. You don't need to know about machine hour method. It's not important. But straight line and reducing balance method is important. As per straight line method, you have to calculate the value of depreciation at once. Okay, every year, the amount of depreciation will be same. Same amount every year. But as per reducing balance method, the amount of depreciation will be reduced every year. Depreciation is reduced every year and it becomes zero at the end of useful life. If the asset's useful life is 10 years, then in the 10th year, the depreciation for the asset will be zero as per reducing balance method. As per straight line method, every year there will be same amount of depreciation, that is cost minus cost minus residual value divided by useful life. That is as per straight line basis. But if you are following reducing balance method, the depreciation amount reduces every year. Got it? These are the three methods available. And when can you go for a change from one method to another? Currently, you are following straight line method. And in the next year, you are planning to choose reducing balance method. Is that possible? Let's see. It is permissible only on the grounds that a new method will give a fairer presentation of results and of the financial position. So if you are following reducing balance method, like if you are changing from reducing balance method to straight line method, you need to have some proof that this new method will help you to give a fairer value. A more accurate figure can be calculated. If you are able to prove this, then you can switch from one method to another. Then another case is if it does not constitute a change in accounting policy. we'll discuss what is accounting policy in IAS 8. Okay. In IAS 8, we'll discount what is accounting policy. So it's just that this change from one method to another, it does not constitute a change in accounting policy. Accounting policy is different. This is just methods for calculating depreciation based on estimates. Okay. So that is what is mentioned here. This is based on accounting estimate. This is a change in accounting estimate and not a change in accounting policy. And the change is only possible on the grounds that it leads to a fairer presentation or if it's required by a new IFRS standard. Okay, got it? So that's about the depreciation. Then, whenever an asset's useful life is reviewed or revised, or if the residual value is revised, in that case, you will be calculating new depreciation. New depreciation equal to cost minus new residual value divided by cost minus, if there is a revised residual value, then cost minus revised residual value divided by revise the remaining useful life. Okay, so that is the new equation. Whenever there is a revision in useful life or residual value, you will be calculating, even if you are following straight line method. As per straight line method, every year you have the same amount of depreciation, but in between, if there is a revision happening for the residual value or useful life, in that case, even if you are following straight line method, you will be calculating new depreciation as on that date. Yes, carrying value as on that date will change. Okay. How the company will prove that old depreciation is not good? It is based on an IFRS standard. Like if you have a new IFRS standard, for example, I can give you as regarding machinery. You were following straight line method for machinery. As per straight line method, every year you are calculating same amount of depreciation, isn't it? But as per the matching concept, only we are following depreciation. We are calculating depreciation. But when you are matching to the income generation, every year you found that this machinery is giving you reduced income. For the first year, from this machinery, as this machinery is new, you got one like what 10,000 as your income. In the second year, from this asset you got only 5,000. From the third year, you got only 4,000. So in that case, you have noticed that this machinery is giving you income on a reduced basis. So when you're matching this income with an expense, depreciating on a straight line method is not a fairer way. So for the machinery, which you found that income generation is on a reduced basis, you can go for, you can prove that since the income generation is reducing every year, we will follow the reduced balance method. Straight line method is not the appropriate method for matching with this income. Like that, you can prove. Got it? And all those things will not be tested for your exam, just for your knowledge. You can keep this in mind. Understand the concept of depreciation well. So when you understand what is depreciation, what is the point of calculating depreciation, then you can see whether reducing balance method is apt for this, like what, machinery, or whether straight line method is apt for this machinery. When it comes to building, it is not like the building or the land will give you a reduced value every year. Okay, from a building, it is located in if it's located in a prime location, maybe if the location is infrastructure wise, if it's growing, then your building's value will be increasing. So you can follow straight line method itself. You don't need to follow reduced balance method for a building because the income generated from a building possibly will not be reducing every year. Okay. So we have to calculate new depreciation whenever there is review of useful life or residual value. Then we have one new concept called overhaul. Overhaul expense is actually a major inspection happening in a company, but we are considering it as a tangible non-current asset. See, it does not overhaul expense, overhaul cost. It is not an item. It is not a non-current asset, but we are considering this as a non-current asset, as part of a non-current asset. Because with this overhaul expenditure, you are expecting the value of your assets to increase. Okay, that is from this certification. If this inspection is over and you have proved that all assets or your company is having like what, a good condition, a very good condition, you got a certification. So based on this certification, the value of asset will be increasing. So anything that increases the performance or value of an asset, that is considered as a subsequent expenditure that can be capitalized, isn't it? So this overhaul expenditure, if you incur an expense for this inspection, this expense will directly lead to the performance enhancement of your asset. That is what you are assuming. So based on this assumption, they are capitalized as non-current assets to the extent that they satisfy IAS 16 rules for separate components. So you are considering this overall expenditure as for the expense incurred for a separate component. Okay, if you are considering this as an asset, what happens? There is where this is the case, they are then depreciated over their useful life, that is until the next inspection or overhaul is due. So when your next inspection is due, after every regular interval, you will be going for overhaul inspection. Okay. So if it's every 5-year duration, then for 5 years, you will consider the duration 5 year as the useful life of this asset, and you will be depreciating this overhaul cost. Okay, so you're considering this overhaul, you're assuming this overhaul expenditure as an item, as a non-current asset. And just as you depreciate a non-current asset, you will be depreciating this overhaul expenditure till the next till the next overhaul expenditure. Okay, from one overhaul, if one overhaul expenditure happened in December 2001 and the next overhaul is scheduled after 5 years, then 5 years will be the useful life of overhaul. So as the straight line method, depreciation is equal to cost of overhaul divided by useful life, 5 years. Got it? That is overhaul. Then subsequent measurement. For subsequently measuring assets of a company, you have two models, that is cost model and revaluation model. As per cost model, carrying amount equal to cost minus accumulated depreciation minus impairment loss. Accumulated depreciation means whatever is the cumulated total of the depreciation till date. That is accumulated depreciation. From the initial cost, if you deduct the depreciation total till date, and if there is any impairment is not a regular event. If there is any impairment, we'll discuss about impairment in IAS 36. If there is any impairment, that is also deducted from the cost, and the remaining value is known as carrying amount. This carrying amount is the amount shown in SOFP as non-current asset. Okay. And if the company is following revaluation model, then carrying amount will be revalued amount minus accumulated depreciation minus impairment loss. So here also you have depreciation, but here depreciation is calculated on revalued amount. We will see what is revaluation, what is the concept of revaluation. And whenever there is a revaluation, you need to recalculate your depreciation. Okay, the depreciation till date, everything will be erased. Okay, we don't have a cumulative depreciation. When you were following cost model, every year's depreciation will be added, isn't it? But in case of revaluation model, you will be erasing every accumulated depreciation till date, and from the date of depreciation, you will start calculating the new depreciation, and that will be accumulated. Okay, we will discuss it later in the next slide. And the same policy must be applied to the entire class of assets. Means if you are choosing cost model, then whole class of assets, means building is one class. If you have two buildings, you cannot revalue one building and you cannot follow cost model for another building. For every building, you need to follow one method itself. Likewise, yeah. Likewise, if you are following reducing this revaluation model for machineries, then for every machinery in your company, you will be following the same model. For one machinery, you can choose revaluation, and other you can choose cost model. It is not possible. Okay, so that is mentioned here. For the entire class of assets, you need to follow the same policy. Okay, so these are the two methods, the two models available for companies to value their non-current assets. Now, when the company is following revaluation model, these are the 5 things that you need to do. As an accountant, okay, as a senior accountant, when you are preparing your statement and in your company, a revaluation took place. What is revaluation? You are checking the value of your asset in the market. If the fair value of the asset is greater than your carrying amount that you have recorded on this previous statement, at that in that case, you will be having a revaluation surplus. Okay, there will be a revaluation surplus or loss where you are comparing the fair value and the carrying amount. The carrying amount as on that date minus the fair value of this date, or you can do the reverse, fair value minus carrying amount. If you get a positive figure by doing this equation, if there is an increased market value for your asset when compared to the carrying amount, in that case, this increase is known as revaluation surplus and the decrease is known as revaluation loss. So, whenever there is revaluation, us as senior accountants need to follow these steps. Restate the assets cost to its new valuation. Now, the assets cost will not be recorded in the SOFP. We are restating the cost to its new revalued amount. And from this revalued amount, you will be deducting the new depreciation. Okay, so eliminate any existing accumulated depreciation. Okay, any existing accumulated depreciation is removed and we are calculating new depreciation. Okay, so the total increase in other comprehensive income at the foot of this SOPL. In SOPL, we had another subheading, other comprehensive income, and the amount of revaluation surplus will be included in other comprehensive income, OCI, and from the OCI, the same value will be taken to revaluation surplus that we discussed in statement of changes in equity. Okay, so we have to do all these things. The new value minus depreciation for the new depreciation. New value minus new depreciation will be recorded in SOFP. Any accumulated depreciation till date will be eliminated. Then the amount of revaluation surplus will be taken to OCI and the same value will be taken to equity under SOFP. That is why SOFP is given here. Then you need to calculate the new depreciation and the new depreciation will be taken to statement of profit or loss. Then if there is a change in depreciation, there will obviously be a change in depreciation. That is initially before revaluation, you had depreciation as 1,000, for example. And after revaluation, you got the new depreciation as 1,500. So the difference between these two, difference between 1,000 and 1,500, this 500 will be considered as change in depreciation and it is transferred from revaluation surplus to retained earnings. This happens within the equity element itself. Under equity itself, you are transferring from revaluation surplus to retained earnings. This is not mandatory. Second point, eliminate existing accumulated depreciation. For example, if you are revaluing regularly every year, and it is not necessary that every year you need to do revaluation. But if you are revaluing regularly means the second sentence is of no relevance. Okay. In December 2001, you had a revaluation. December 2002, you had a revaluation. In that case, the second sentence is not relevant. But usually what happens is 1 year, let's say in December 2001, you had a revaluation. And after 3 years, you are doing the second revaluation. So from the first revaluation, you will be calculating a depreciation. And this depreciation will be there in year 1, 2, and 3 until there is the next revaluation. So whatever is the accumulated depreciation till that date, okay, from the first revaluation till the next revaluation. Or sometimes there may be a switch from cost model to revaluation model, isn't it? So when you are doing a revaluation, until that date, whatever is the accumulated depreciation, that figure will be erased. You will not be considering that accumulated depreciation for calculating the carrying amount. The accumulated depreciation that is used for calculating carrying amount is the new accumulated depreciation from one revaluation date till the next revaluation date. Got it? Yeah, let's say if you had a cost 10,000 and your useful life was 10, in that case, depreciation per year will be 10,000 divided by 10 years, that is 1,000. Now, for the first year, you recorded depreciation 1000, and second year, you recorded 1000. Now, your accumulated depreciation is 2000 for the second year. In the second year, when you are calculating this new depreciation based on a revaluation that took place, this new depreciation will not be 1000, isn't it? New depreciation will be different. So on that date, you will be releasing this 2000, whatever is the previous accumulated depreciation. Till that date, just erase it, just eliminate it. That is not required for our calculation. We only need the new revaluation to be recorded in the SOPL. Yes. So these are the things happening in SOPL. Sally, can you please? Yeah. So these are the things happening in the statements when you are doing a revaluation. In SOFP, the new value will be the valued amount of the asset will be given. Then any depreciation till date will be ignored, will be eliminated. The revaluation surplus will be shown under OCI, and the same amount will be taken to SOFP under equity. Then new depreciation will be shown in SOPL, and this last point, it is not mandatory. Only if it is specified in the question, you can do this. Okay. If it's specified that a transfer is necessary, in that case, whatever is the excess depreciation, this excess depreciation will be transferred from revaluation surplus to retained earnings. Deduct the value from revaluation surplus and add the same figure to retained earnings under equity. These are the things happening in the statements whenever the company has a revaluation of an asset. Then, when you are disposing a revalued asset, disposal means sales. What is the term meaning of disposal? It means sales. So when you are selling a non-current asset, you have two things to do. First thing is, it should be accounted for in SOPL of the period in which the disposal occurs. So in SOPL, you need to record the gain or loss. It means the gain or loss. Here, profit or loss on disposal of revalued asset should be calculated as difference between net sale proceeds and carrying amount. So simply you can say that gain or loss is equal to sales proceeds minus carrying amount as on that date. This gain or loss should be calculated whenever there is a disposal. Gain or loss is calculated and is recorded in the SOPL. Then one more thing that you have to do is any balance on the revaluation surplus relating to this asset should now be transferred to retained earnings. So here there is a transfer from revaluation surplus to retained earnings. Again, if you have you are selling a revalued machinery, for example, in that case, this machinery has a revaluation surplus in the equity, which is 10,000. So when you are disposing this, the 10,000 amount from the revaluation surplus will be deducted, and this 10,000 will be added to retained earnings as a part of profit. Okay, the assumption is like anything in the other comprehensive income is unrealized. So when you are disposing this asset, the amount is actually realized, and this realized value is shown in the retained earnings. So there are two things that you need to consider whenever there is a disposal. First one is calculate the gain or loss and show the gain or loss in SOPL. Second one is transfer the value based on revalued amount, revaluation surplus based on this asset from the revaluation surplus to retained earnings. These are the two things that you need to do whenever there is a disposal. So that's all about IAS 16. When you are buying an asset, what happens? Okay, what is the initial cost? What is the subsequent expenditure? How to classify among capital and revenue expenditure? Then what is depreciation? What are the methods of depreciation? What happens when there is a revision in useful life or residual value? Then what is the major inspection and how to treat overall expenditure? Then subsequent measurement, that is, you have two choice, cost model and revaluation model. Then whenever there is a revaluation happening, what are the 5 things that you need to do? And when you are disposing an asset, what are the things to consider? So that's all about IAS 16, property, plant and equipment. Anything regarding a business asset. Okay. And next is IAS 23, borrowing cost. So before going into borrowing cost, let's take a short break. because we have already covered 2 hours. So let's take a short break of 10 minutes. You can also drink some water, go fresh up, and come. And we will continue with IAS 23 and we'll take the remaining standards and consolidation and interpretation after the 10-minute break. Okay. Please be back by 6:10. Now it's 6 p.m. By 6:10, we will continue.